Hey everyone, this is Kirk here again at optionalpha.com, and welcome back. This is the video recap that we do here each and every night on the membership side of our blog, where we go over all of our opening, closing, and or adjusting trades. Now tonight we're actually going to cover just two of our opening orders to kick off the week here on Monday. Even though it's the last day of the month, actually really are just really starting to get into July expiration month, contract month here. But these are both trades for August as opposed to trades for July. So now that we're definitely into the month of July, we want to kind of start rolling our trades, not in the literal sense of rolling the positions, but actually kind of looking at trades that are more further out in August. Gives us a little bit more time. The July options right now are just really too close to kind of make worthwhile for our investment. So we're going to look out to August and continue to build that side of our portfolio and just keep whatever we have for July going forward. So the first trade that we entered today is a very simple debit spread in V, which is Visa. And it's a little bit difficult with these one letter tickers, but like V and X and O and things like that, it's very easy once you actually understand it. But again, this is just a vertical debit spread in V, which is Visa. It's for August 14, which is basically just designating the August 2014 contracts. And we went ahead and bought the 205-215 call spread. So we bought the 205 and then we went ahead and sold the 215 against that, which is right now out of the money, and that gives us a little opportunity to buy that spread, and we paid a big difference of $5.50. So it was actually a pretty high value spread, meaning that we paid a lot of money, and that's only because the width of the strikes is about $10. So we could have made this a little bit closer, made a $5 wide spread, we would have paid half of that, but I'll show you guys why in a second, why we paid a little bit more money for a wider spread. And that's because we want to get our break-even point at a comfortable range, and why it's so important I'll get into here in just a second. But let's just look at the chart of Visa, and you can see that this is where Visa has been. It's had a pretty rough time in March and April, but has really kind of recovered. And so what we're doing here is just, kind of buying a little bit of Visa and saying, you know what, if we do get a nice little rally before earnings, because earnings are coming up here in the at the end of July, that we could see a nice little rally into earnings. Obviously, implied volatility is very low right now, so if we do have a rise up in implied volatility, that helps this position. And typically with some of these big name stocks like Visa and Apple and Google, we get a nice move up in implied volatility as earnings approach. So as earnings approach, and hopefully as the stock continues to rally here a little bit, we could have a nice move higher in implied volatility, which will obviously help our debit spread position. So if I actually go to the trade tab here of Visa, you'll see that we're not trading July. July only has about 18 days to go till expiration. What we want to be focusing on is about August, which has about 46 days to go. It's a pretty average range for us to have about 46 days, 46 to 60 days out for some of our spreads. So here's why we didn't make a very simple $5 wide spread. Okay, so we did a $10 wide spread, which is a 205 and 215. Now, I usually talk about a lot making a spread that kind of straddles the market. So one option that's in the money and one that's out. Well, right now Visa is trading at 210.71. So if I go with that assumption that we go with the in the money option, that would be the 210 and the 215. So a $5 wide spread. And so in most cases, some traders that get into this business, they look at this trade and go, okay, I'm buying a $5 wide spread for 228. So about half the price of the spread that Kirk just bought, which was $10. But here's where you get caught, is when you hit confirm and send here and we bring up this dialog box, look at where our break-even price is on this stock. So our break-even price for this trade is $212.28. Now, if you compare that to where the stock is actually trading right now, which is $210.71, that basically means that you need the stock to move about $2 before you even begin to make money at expiration. And so for me, I don't like to take that kind of risk, right? Even though it's a little bit cheaper, I'd actually like to pay a little bit more money and get my value out of the spread by making the spread just a little bit wider and kind of moving the break-even point closer to 210. So again, at this point, you could pay less money, but you actually need a $2 move up in the stock before you even begin to make money in this trade going forward. And remember, this should be a 50-50 bet, and that's not a 50-50 bet if you need the stock to move higher. So what we did is we did a 205. So we just went ahead and adjusted our call spread down on the long side. So we bought the 205, sold the 215. we paid about 250 today, and it's trading at 225, but the same kind of principle and logic applies, that once we hit confirm and send, now we see that our break-even price is much closer and in fact lower in most cases than the actual price of the security. So we're actually buying this spread with a little bit of value kind of built in here, basically saying that if Visa does nothing between now and expiration, we actually will make money on this spread. Visa doesn't have to go anywhere. It can sit right here at 210.71 all the way to expiration, and we make money on this trade. Now that's not the same if we did that other spread where we did a $5 wide spread. So you can start to see that just choosing the right strike prices becomes very important, and you have to factor in things like your break-even point and where the stock is right now. It's just not a matter of going out and looking for a cheap spread. So hopefully that kind of drives home the point we talk about a lot in video tutorials. So just go back through and check out a bunch of those. We have a lot of examples of this. All right, so the other opening trade was a little bit different. We actually had an opportunity to sell some premium finally. So we're starting to see implied volatility start to slowly creep up in a lot of securities. Went ahead and did a bullish debit or credit put spread in YHOO. So we are bullish on the stock. We want YHOO to go higher. So we went ahead and sold 3 of the vertical 33.31 credit put spreads. So again, a $2 wide spread. We take in a nice credit of about 60 cents, just widening out the spread. Great volume today in YHOO, great liquidity in the stock overall. It's a very big name. And I like where our position is because it puts our break-even point around 32.50 or so. So that really helps given that the stock is, very volatile. So we want the stock to go higher. And if it does, or even if it does go a little bit lower, we actually make some money. So with YHOO, it was really a major volatility play because we have volatility right now with YHOO up in the 60th percentile. So you can see up in the top left-hand corner of your screen here that the 60th percentile means that almost 60% of the time implied volatility is lower than it is right now, which gives us a great opportunity to go ahead and sell some premium. And the stock is starting to rally before earnings, right? So I think that at some point we're going to see a continued rally as we head towards earnings. I definitely know it's on the calendar. It's not that I'm avoiding it. I want kind of selling that premium ahead of earnings. And I'm really looking for a directional move here. But if we need to hold it through earnings, we're definitely going to get that earnings crush that we're really expecting with a lot of these stocks around this time, is that earnings will drop after earnings or implied volatility will drop after earnings are announced, which only helps our position. So again, you remember I said that our break-even price is right around 32.50. So this is kind of our line in the sand, if you will, on where YHOO is. It gives us a lot of margin of error to the downside. So YHOO can basically retrace this $1.50 move that it's had over the, or $2.50 move that's had just in the last couple of days. It can do all of that and we still make money. It can trade sideways and we still make money. And obviously we just hope it continues to move higher. That's obviously the best situation. We make a lot of money much faster in that scenario. So that's exactly what this trade looks like as far as the layout of it specifically. If we go into the trade tab here, and you start to see that we're already making about $7 on this trade, which is really not a lot of money for the first day, but that's okay. It's going in the right direction. But you see that our first strike here is right around 65.5. So our probability of profit of YHOO making it down to and closing below 33 is around 64.5. Call it 65. That's our probability that YHOO gets down there. But remember, our break-even price is around 32.50. So that kind of puts it somewhere in the middle of these two ranges here. So we just basically call it somewhere around 70% chance of success. So a pretty good high probability trade. That's what we like to see. There's not a lot of these out here right now. So this makes this particular trade very attractive for us as far as a high probability trade. And we definitely have some more room to scale into this as we get closer to earnings. So I've kept the position size a little bit small to start here because I'm anticipating that we still get a little bit possible higher move in implied volatility as we get closer to earnings. And we might go ahead and turn this into an iron condor or something right before earnings and kind of make it very neutral and even on both sides. So as always, hope you guys really enjoy these video tutorials. If you have any comments or questions, please add them right below here. If you're watching this video publicly on YouTube or somewhere else online, you just have to understand that you're actually getting this video about 10 to 15 days after these alerts and this video is sent out to our members. So you can only get up-to-date and live market data like these videos and these alerts that we send out by signing up at optionalpha.com. It's completely free to get started, no credit card required. go ahead and kick the tires, see if it's something that you like. As always, hope you guys enjoy these videos. Let me know if you have any comments or questions, and happy trading.